Greetings of the day and welcome to our talk on financial crisis, causes and recovery plans. The Asian financial crisis began in Thailand and spread to almost all Asian countries, including Malaysia, Indonesia, Japan, and South Korea in the mid-1997. During the crisis peak, all crisis-hit countries experienced currency devaluation, crash of stock markets, and the depreciation of assets. After the attack on the Thai currency on July 8, 1997, Malaysia was under attack by currency speculators that led to comprehensive sales in the stock market and exchange market. KLSC index, the Kuala Lumpur Stock Exchange Index, plummeted from 1,200 points to below 600 points. The ringgit declined by 50% from RM 250 to RM 410 per dollar. The factor that caused financial crisis was speculative attacks. The Malaysian economy was vulnerable due to the unsustainable pace of economic growth and overvalued exchange rates. The relationship between firms, government, and banks in Malaysia in the financial crisis period cannot be described as good compared to other Asian countries. There was no clear policy and directed lending to big firms, and to that extent, one cannot say that the financial constraints on big firms were weak. The government came out with a higher growth policy based on the high ratio of investments to gross domestic product, complemented with the promotion and support of certain mega projects, which led to implicit assumptions by lenders that the government would not let those projects fail, which was helped by lending decisions by bankers based on not only a project's cash flow, but also on collateral and implied government support. The overinvestment was fueled by an aggregated demand to outstrip aggregated supply, with a consequently persistent external deficit. Moreover, it had also led to poorer cash flow and more problems of loans. Furthermore, the factor caused financial crisis in Malaysia was due to poor laws and weak enforcement. The legal infrastructure in Malaysia was plagued by inadequate reliance on markets due to its weak infrastructure in private contracting, which in turn was attributed to poor laws or weak enforcement of those laws. The investment decisions were based on the relationship model rather than on market prices, whereas contract need not manage the supply of capital relative to investment opportunities, which were limited. In order to protect their interests, foreign lenders to Asian corporations and banks invariably made short-term loans, relying on the threat of not rolling over the loans to ensure borrowers service the latter. When the Asian economic crisis occurred, a major of the lenders took back their loans, and this caused the capital outflow without any control. This was considered to be a rational response by the lenders in taking their time and going to courts to enforce their rights. The Malaysian government established the National Economic Action Council, NEAAC, on 7 January 1998. As a consultative body to the cabinet to deal with economic problems inflicted by the crisis and restore the Malaysian economy back onto its growth path. In late July 1998, the NEAAC launched the National Economic Recovery Plan, NERP, which recommends wide-ranging proposals for economic stabilization, recovery, and structural reform. The action taken by Malaysian government to overcome the financial crisis was stabilizing the exchange rate. The ringgit was fixed at 380 to the US dollar, thus ending the previous flexible exchange rate system. This was put to currency fluctuations and speculation. It allowed the macroeconomic policies to be implemented and prevented a possible debt servicing crisis, which could have occurred if the ringgit had depreciated to below a certain level. Besides that, in order to resuscitate the economy, the government embarked on an expansionary fiscal policy. In July 18, 1998, it unveiled a fiscal stimulus package of RM 2 billion, which turned the budget from a surplus of 2.5% of GDP in 1997 to a deficit of 1.8% in 1998 and then a 3.2% in the year 1999. That is all from us. Thank you.